We're starting.
So, now you can start.
I'd like to welcome everyone back to today's talk with Steve Keen. This is also the last talk before the summer break. We're very, very pleased and honored to have Steve with us again. And I think you're looking at the headlines today with New Republic Bank. It's the topic could not be more current event than it is. I'll keep this very brief as usual. We'd like to thank Rosa-Luxemburg-Stiftung and Oxi.Wirtschaft denken. These are the people who finance these talks, and we are very, very appreciative of it. They've been doing this for years, and this just wouldn't exist without them. I'd also like to thank the interpreters. You have no idea how much work goes into this. It sounds like very simple to say thank you, but it's much more. It's a very heartfelt thing to Oscar and Florian. And then, of course, Frank Engster, who does all the organization, and Sven Buchin, who does all the technical side of this, and it's very complicated in the meantime. I'd like to also thank them for very heartfelt things, and for getting us through this half year. That's about it for the moment. I'll just turn this over to Steve now to do his talk. We'll have a question and answer period afterwards. You, of course, can do that via YouTube. All right, Steve, the floor is yours.
Thank you, Matt. Thank you very much. I'll just share my screen here. And okay, so I know I talk far too quickly, even for my fellow Australians, so I'm going to try to speak more slowly now to give my translators a chance, but I do apologize if I speak too quickly for some people, indeed for most people. So what I want to talk about is how central banks are actually causing the next financial crisis. And they caused the one beforehand. This one they're causing by deliberate action. The last one they caused by negligence. So if we take a look at what's happening right now in terms of bank failures, 2023 is now, though the number of bank failures is quite small, 3 so far versus 25 in 2008, the actual value of the failures is already, with 3 banks, bigger than it was in 2008 with 25 banks that failed. And mainstream economists are fundamentally responsible for both. And there's 2 reasons. Back in 2008, they completely ignored the private debt bubble that was blatantly obvious in the data, but according to their theories, private debt doesn't matter, so they ignored the data, and that's what led to the crisis. And now they're ignoring, or they were initially ignoring, they may now be taking it more seriously, the impact that rising interest rates have on the value of bank assets. And that is fundamentally what has caused the failure of the 3 banks that have failed so far in America. And of course, there are some in Europe which are failing as well. So this is the most recent one, just in the last 1 or 2 days. And that's the second biggest bank failure since the collapse of Washington Mutual, which had a value of basically $500 billion. This one has a value of 1/5 of a trillion, and we're now talking in terms of serious impact upon the payment system. Now, the first thing I want to cover is why mainstream economists do not understand private debt and why that causes so many problems. And the reason is they fundamentally have a barter model of the economy. They imagine that money is what they call a veil over barter. And so they, rather than being experts on money, which is what most people who are not economists believe economists must be, because most people think, well, economics is about money, so obviously economists have to be experts on money. In fact, they're experts on dreaming up reasons to ignore the monetary system, and their models do not include debt or money. And you can see this in how Ben Bernanke reacted to Irving Fisher's explanation for the Great Depression, which he called the debt deflation theory of Great Depressions. And he said academics ignored his argument because of the counter argument that debt deflation is no more than a redistribution from one group, debtors, to another group, creditors. And he then said, unless there were enormous differences in their propensity to spend, pure redistributions should have no significant macroeconomic effects. So what he is saying is a debt is simply a redistribution of existing money. It does not create new money. That's his belief. Now, Krugman, who of course is in the same theoretical camp as Bernanke, said that it's the level of debt doesn't matter, only the distribution of debt matters. So he said, to a first approximation, debt is money we owe ourselves. And therefore, the overall level of debt makes no difference to aggregate net worth. One person's liability is another person's asset. He says, therefore, the level of debt matters only if the distribution is significant. Otherwise, you can ignore the level of private debt. Now, if they're right, what that would mean is you could take a look at the rate of change of private debt and the level of private debt, and you'd find no significant correlation with macroeconomic variables, let alone with macroeconomic crises like the Great Depression or the 2008 global financial crisis. So here's the data. The top graph shows the ratio of private debt to GDP. And you can see there've been a rise up to the end of the First World War, another rise up to the middle of the Great Depression, then a plunge across the Second World War, and then at the highest level in history during the global financial crisis. And down the bottom, what I'm plotting with the red line is the annual change in private debt, which I call credit. So debt is the money you owe, which is denominated in dollars. Credit is the change in the amount of money you owe, which is denominated in dollars per year. And when you look at the level of credit, which is the red line graphed against the left-hand axis, it went from about 10% of GDP in 1930 to about -10 in 1933. In 2007, it went from 15% of GDP to -5% of GDP. So if you take a look and say, well, here's the Great Depression, a high level of private debt, and a turnaround from +10 to -10% of GDP in the rate of change of debt or credit. And here's the global financial crisis, a high level of debt, a high level of credit-based demand, a similar fall in credit-based demand. So, and then the black line is the unemployment rate. And you see unemployment falls when credit rises. So you have this period here where the unemployment rate is falling as credit is rising. And then when credit collapses, unemployment increases. So there's something wrong with the argument that you can ignore credit. And there's one of my favorite sayings in the history and philosophy of science from Thomas Huxley, talking about a proposition in eugenics back in the 19th century. The great tragedy of science, the slaying of a beautiful hypothesis by an ugly fact. So here's an ugly fact that slays a beautiful hypothesis, that you can ignore the level of private debt. So let's derive a hypothesis from these facts. And my hypothesis is going to be that credit is part of aggregate demand and aggregate income. And that's why it has the enormous impact you can see upon the rate of unemployment, which is obviously a crucial macroeconomic variable. So the proof is going to be slightly complicated, and I apologize for the stretching brain cells at this time in the evening, but the starting point is one of the very few things that all macroeconomists, regardless of their disposition, whether they are neoclassical or post-Keynesian or Marxian or even Austrian, agree that aggregate demand is aggregate income. And the reason for that is your spending is someone else's income. So if you add up the aggregate of all spending, you'll find that it is identical to the aggregate of all income, for that simple reason that what you spend is received, what you spend is which is your expenditure or your demand, becomes income for somebody else. So I'm now going to illustrate that with a very simple example of where I divide the economy into three sectors: households, services, and manufacturing. And I have households spending A dollars per year on services and B dollars per year on manufacturing, services spending C dollars per year on households and D dollars per year on manufacturing, and then manufacturing spending E dollars per year on households and F dollars per year on services. And you can put this together in a table where the rows show expenditure and the columns show net income. So here's households, and they're spending A dollars per year on services and B dollars per year on manufacturing. So if you add up the row, you get 0. And that's the identity of aggregate demand and aggregate income. Services, C dollars per year on households, D dollars per year in manufacturing, manufacturing, E dollars per year on households, F dollars per year on services. Now each row sums to 0. The rows can be non-zero, but the sum of all the rows is also 0. And if I want to identify aggregate expenditure, then it's the negative of the sum of these diagonal elements. If I have minus A minus B minus C minus D minus E minus F, I get A plus B plus C plus D plus E plus F, which is expenditure per year. And that is necessarily equal to income per year, which is the sum of the off-diagonal elements. So all I need to do is sum up either the off-diagonal or the diagonal and take the negative, and I know what aggregate demand and aggregate income are in this particular model economy. Now, at the moment, I'm ignoring lending. So I have people spending out of existing money. There's no borrowing and there's no debt in this model. When you bring in lending, lending is a transfer. It's not buying something off somebody else when you lend somebody money or when somebody else lends you money. So you show this as a transfer along the diagonal. So if services lends to households, there's an amount coming out of here, which is matched by an entry going in up here. So I'm going to show this, I'm going to model this as saying that credit dollars per year are lent by the services sector to households, and then households spend credit dollars per year on the manufacturing sector. So that's the next diagram here. And this is what is known as loanable funds. This is the model of banking that conventional economists like Ben Bernanke, Paul Krugman, and virtually everybody who works for a central bank believes describes the real world, or they think it's a simplifying assumption to say that banks are intermediaries who arrange loans between people who save and people who wish to borrow. So what I have here is the services sector is going to be lending credit dollars per year to households. Households have to pay interest dollars per year to services for the debt they've accumulated so far, and then households spend that credit on the manufacturing sector. So it's slightly more complicated diagram, but the basic idea, D minus credit is being spent by services on manufacturing. Credit dollars per year are being transferred to the household sector, and then the household sector is using those credit dollars per year to buy B plus credit rather than just B dollars per year worth of manufacturing goods output. Now, when you do the sum and you add up the different, either the off diagonals or the diagonal elements, you find credit cancels out. There are 2 entries for credit there. One is positive, the other is negative. So credit disappears. But interest, there's only 1 entry for interest on the diagonal and 1 on the off diagonal, which means that interest demand, interest expenditure and interest income are part of aggregate demand and aggregate income. But if this was correct, credit wouldn't matter. And this is the mental framework inside which conventional economists live. And with that assumption, they ignore credit. Now, as I've shown from the data, credit does matter. I get an enormous correlation between credit and unemployment. And the reason is that banks are not intermediaries between savers and borrowers. They are what I call bombed. They are creators of both debt and money. When a bank lends, it creates an asset for itself, which is the debt, and a liability for itself, which is the deposit of the borrower. So my acronym for what banks actually are is BOMD, Bank Originated Money and Debt. Now, you have to include the banking sector now. And the banking sector, of course, has assets, which are the loans that it's issued already, and liabilities, which is money. So economic activity occurs on the liability and equity side of the banking sector. So now I'm going to show a much more complicated table. So here we have households have got a loan from the banking sector. So household debt is increased by credit dollars per year. And because of that, there's credit dollars per year flowing into household accounts. And they then spend those credit dollars per year on the manufacturing sector. And they pay interest dollars per year to the banks. So the same logic applies. The negative of the diagonal is aggregate expenditure. The sum of the off-diagonal elements is aggregate income. And when you add them up, you find credit does not cancel out. There's one entry for credit in aggregate income. There's one entry for credit in aggregate expenditure. So credit is part of both aggregate expenditure and aggregate income. So if you're ignoring credit, you're ignoring the most volatile component of aggregate demand and income, because the transactions-based income, which is what the A plus B plus C plus D plus E plus F are all about, they vary more slowly and they can't be negative. You cannot spend negative dollars out of your transaction account, but you can have negative credit. You can pay your debt down. So credit can be negative rather than positive. And it also varies very quickly. So what you find is credit is the driving force of a capitalist economy. And Hyman Minsky understood this, and he developed the financial instability hypothesis based on the logic that credit is part of aggregate demand and income. And here's his basic argument. And this alone doesn't just distinguish Minsky from neoclassicals, it distinguishes him from a lot of even post-Keynesians as well, because he saw a relationship between debt and income. And that has escaped most economists, even most post-Keynesian economists, until recently. So he says the natural starting place for analyzing the relation between debt and income is to take an economy with a cyclical past that is now doing well. He said, as the period over which the economy does well lengthens, so you've had a crisis in the past and the economy has now recovered, the longer the recovery goes on, boardrooms start to realize, first of all, that existing debts are easily paid and units that were heavily in debt prospered. It paid to lever. So this now encourages corporations to take on more debt. So the acceptable amount of debt used in financing activities and positions increases. So stable growth is inconsistent with the manner in which investment is financed in a debt-based economy. And this is, I think, one of the most insightful sentences in the entire history of economics. He says it follows that the fundamental instability of a capitalist economy is upward. The tendency to transform doing well into a speculative investment boom is the basic instability in a capitalist economy. Now, I discovered Minsky's work in 1987, and I decided to do my PhD by making a mathematical model of Minsky's hypothesis, which Minsky never managed to do successfully himself. And I published it in 1995, but I actually wrote the model in 1992. And this is the model done in my software package, Minsky. I'm happy to discuss this in the question period. And what you see is the cyclical economy, as Minsky said, but the cycles are getting smaller over time. And this can look, if you're a neoclassical economist, this looks good. What doesn't look good is what you're now starting to see on screen. The cycles, having been getting smaller for a while, are now getting larger. You can see that the level of the wages share of GDP is falling over time. The cycles start to get more extreme. The bottom right-hand graph, which shows the ratio of the relationship between the profit rate and the level of debt, starts to give you negative profit rates. And ultimately, the system, if I run it for long enough, will collapse. Now, my reaction when I simulated this model became the final paragraph of my paper on this model. And I said the chaotic dynamics, and this is a chaotic or complex systems model, should warn us against accepting a period of relative tranquility in a capitalist economy as anything other than a lull before the storm. Now, this is what actually happened. We had, with the global financial crisis, before it happened, we had a period that the mainstream economists called the Great Moderation, with unemployment and the inflation rate falling before the crisis. So this was what neoclassicals were looking at. They ignored the level of private debt, they ignored credit, they were looking at the inflation rate and the unemployment rate, and they thought they were doing a wonderful job. And here's Ben Bernanke, who at the time was a deputy chairman of the Federal Reserve, saying the sources of the moderation remain controversial, but improved control of inflation has contributed to this welcome change to the economy. Now, he saw a welcome change to the economy. I saw a potential harbinger of crisis. And when I saw this turning up and the rising levels of debt as well, I wrote in May of 2007, and I've written many comments before this, but this is probably the most direct to it, that the debt to GDP ratio must stabilize, and when it does, we will have a recession. And I started warning of the crisis from December of 2005 and started publishing a monthly report in November of 2006. And the focus, again, taking from the work of Hyman Minsky, with the private debt is by far the most important economic issue today. That's what economists should be focusing upon. By ignoring it, they were setting us up for a financial crisis. Now, this is what actually happened. And it hasn't just happened once, it happens throughout the history of capitalism. So I've been able to construct a time series going back to 1834 for the level of private debt. And the top graph here is showing you the ratio of private debt to GDP. And the bottom level is showing you the annual change in debt, which is credit. Now, this, of course, is the global financial crisis, which most of us here would have lived through. This is the Great Depression. But I had no idea what this was until I plotted this graph. I thought, hang on, what happened in 1837? So I went and did a literature survey, and I found what was called the Panic of 1837. And this was how it was described in a recent economic history book. It said, an economic crisis so extreme as to erase all memories of previous financial disorders. And you can see the basic pattern that I'm talked about for the Great Depression and the Great Recession applying here. A period of rising private debt and then falling private debt, with credit being substantially negative for a substantial period of time, not quite as long as the Great Depression, but a period of substantial negative credit, therefore aggregate demand and aggregate income being reduced by the actions of the financial system. Now, by ignoring disequilibrium and private debt and deflation, central banks allowed the conditions that caused the Great Depression to recur. And that was too much private debt and too low a rate of inflation, just as Fisher had argued back in 1933. So Fisher was a mainstream economist, just like Bernanke and Krugman and co. He ignored the level of private debt and he ignored disequilibrium. He then lost he lost all his wealth in the financial collapse of the Great Depression. And in that state, he went back and seriously examined his own thought. And he then said, well, it's an error to believe that the economy can ever be in equilibrium. He said, theoretically, there must be over and under production, consumption, spending, saving, investment, and everything else. It is absurd to assume that the variables in the economy will remain in perfect equilibrium as it is to assume that the Atlantic Ocean can never be without a wave. Now, the most important disequilibria here identified were debt and deflation. He said in the great booms and depressions, the two dominant factors are over-indebtedness to start with and deflation following soon after. And that's precisely what we see when we look at the data. So here is the period from 1920 to 1940. You have private debt rising from 60% of GDP to 140%. You have a period of low inflation and then deflation. Now we look at what happened in the 2008 crisis. From 1990 to 2008, we had rising private debt and low inflation followed by deflation. there's rising private debt. And again, there's low inflation. And again, and there's deflation. And not lasting for as long, but we had deflation briefly during the 2008 crisis. So now we're having, so this is the first crisis that central banks caused by ignoring the causes of financial crises, because the causes of financial crises involve taking money seriously, having private debt in your thinking, and knowing that the economy is in disequilibrium. And those three things, the three things mainstream economists cannot cope with, so they ignore them. Now, if you look at inflation, what's of course freaking central banks out now is inflation has gone from below 2% to well above 2%. So this is the long-term history of inflation in the post-war period. You can see the inflation back in the 1970s and early to late 1970s was much higher than it is now. But for a substantial period of time, the inflation rate was below the 2% target the central banks set for themselves. So before the crisis, during the crisis, and after the crisis, rather than hitting the 2% target central banks set for themselves, it was well below, then suddenly it shoots up. It's now falling, but it shot up dramatically, and they weren't prepared for it. So they increase interest rates because they believe that you can control the inflation rate using the interest rate. So here's again a post-war period looking at the interest rate set by the Fed in the nominal interest rate, and then the red line is the inflation, is the nominal rate of interest minus the inflation rate. So that's what you can call the real rate of interest. And you can see that for much of the period from 2000s forward, the real rate's been zero or negative, and at the moment it's substantially negative, and that's what they think is causing the inflation. And they think they can reduce inflation by reducing what they call inflationary expectations. Now, this is from a fairly conventional economic source, the Brookings Institute. And they think that inflationary expectations cause inflation. So if they can stop you expecting inflation, they think they can stop inflation itself. And this piece of magic derives from Milton Friedman. And he built a model in which the market was in complete equilibrium and prices were rising at 10% per annum. So he said, what raises the price level if all markets are cleared and all real magnitudes are stable? He said, because people expect prices to rise. So this is where this idea comes from. And he says, prices rise because everybody knows they will. So all the demand and supply curves in nominal terms rise at 10% per year, and so do market clearing prices. Now, that's a very elaborate piece of bull dust, and I want to explain why. Because let's take an empirical look at what causes inflation. And the great Polish non-orthodox economist Mikhail Koleski broke inflation down into three factors. He said that there's change in the markup, which is set by firms, change in wage cost, which fundamentally reflects the capacity of workers to bargain for higher wages, and there's change in output per worker. Those are the three factors. And in this 1970s inflation, which is here, you can find all of those three factors. So if you just disaggregate the data, you find wage change was rising towards the from 75 to 80, and it's also from the 1970s on. Labor productivity was falling, which makes prices rise, and the markup was rising as well. And with rather a similarity to what we're going through right now, the markup and rising markup and falling productivity were more persistent than changing wages. But when you take a look at the aggregate impact of inflation and wage demands on real wages, you find that there were periods of rising and falling real wages across that period. So from late 1970 to 1970, end of 72, real wages were rising. Then they fell during a period of high inflation. Then workers got wage rises. Then the high inflation took over. So periods of rising and falling real wages during the 1970s. Now in the 2020s, and this is the inflation from January of 2020 out to February of this year. Not as extreme as back in the 80s, of course, but when you do that disaggregation and break the inflation down into those three causal factors, you find that wages were rising but generally flat. There's no upward trend there. And in fact, for the whole of most of the inflationary period, nominal wages have been, the rate of increase of nominal wages has been falling. But labour productivity has been falling for obvious reasons in the period of COVID and also high energy costs, and markups have risen dramatically. And this is the most important point. The markups are what have driven the increase in prices, not wages, but increasing markups by firms. And when you look at the end, real wages fallen throughout the whole experience. A very, very brief period around between June and October of 2021, when real wages rose a bit, but for most of the period of inflation, real wages have been falling. So you can't blame the workers for the inflation we're going through right now, but they are the ones that are being targeted by the Federal Reserve putting up interest rates. Now, mainstream economists, as I said, think they can control the inflation rate by varying the rate of interest and changing people's expectations without actually having much impact on the real economy. Blair Fix does a wonderful job of deconstructing that and says it's nonsense to think that interest rates control inflation. Interest rates will rise with rising inflation, but increasing interest rates doesn't reduce inflation. But what they are doing is causing a banking crisis, and this is why I'm saying there's a second reason why the central banks are responsible for the current crisis. Now, banks and non-bank financial institutions hold treasury bonds, and that's one of three types of assets they have. And from 1980 until 2022, because interest rates were falling, the value of the treasury bonds that these institutions held were rising. Now we have rising interest rates, and that causes the value of treasury bonds to fall. Now, neoclassical economists weren't prepared for the impact this would have upon the banking sector, because the models they build, which they call dynamic, stochastic, general equilibrium models, don't have banks, don't have private debt, and don't have money in them. So the causal factors that they should be looking at aren't even in their models. So it makes them blind to what's going to happen to the value of bank assets if you increase interest rates, because they don't even have banks in their system. Now, when you take a general look at banks, they have three main types of assets. They have loans, which they create by lending. They have reserves, which are created by government deficits, and I'm happy to talk about that in the discussion period, if necessary. They used not to earn interest. Ever since the global financial crisis, they are normally paid interest on excess reserves, 0.25% below the official interest rate. And then treasury bonds. Now, treasury bonds are created by the Treasury and sold to match the deficit plus the interest payments needed on existing bonds. And they pay what's called a coupon rate of interest. So, for example, if you had a 30-year bond and it advertised itself as giving you a 5% yield, and it cost you $1,000 to buy the bond, then for 30 years, that bond will pay you $50 per year. Now, that means that if the interest rates rise in general, then the value of that bond is going to fall. And I'm going to give an exaggerated example here, where I pretend that all bonds are what are called consols, and consols last forever. And therefore, because they last forever, there's a direct inverse relationship between the current interest rate and the value of a console. So if the interest rates start out at the same level as the console, and consoles yield 4%, this is a British quirk of nature that consoles were invented. So if the interest rate starts at 4%, then consoles sell for 100% of their face value. But if interest rates double to 8%, consoles fall in value by 50%. And this is a very simple illustration of that. So this is a very stylized model. But just to explain the bits and pieces here, this is a model in my Minsky software. So I have the banks having reserves, consoles, and loans as assets, liabilities of bank deposits, and they have equity, which is currently positive. And banks must have positive equity, otherwise they are bankrupt. Then they're being paid interest on consoles, and that's a fixed $1,000 per year, because I'm modeling $25,000 million worth or $1 billion worth of consoles. Therefore, they'll pay $1,000 per year as interest indefinitely. I've got interest on bonds at 2,000, and I'm not varying that rate of interest. So that's a 4% rate of interest on $50,000 in loans. And then the interest payments on the consols actually increase reserves and increase bank assets. So if I run this model initially, because of this effect of interest payments creating money, interest payments on bonds paid by the Treasury, creating money for the financial sector, banking sector equity is going to rise when I first run this simulation. Then what I do is I increase the rate of interest on bonds from 4% to 8% and watch what happens to banking equity, because in this situation, the banks, I'm pretending that all their bonds are affected immediately and totally by the interest rate. So they're forced to revalue the bonds at the market interest rate. That'll cut the rate from the value from 25,000 to 12,500, and that reduces the equity of the banking sector. So that's what's happening down here. I'll have the initial value of the consols, which is 25,000, multiplied by the ratio of the console rate of interest to the rate of interest on bonds. When that's 4% and 4%, the value of consols is constant, so there's no need to revalue. But when you have the increase in interest rates caused by the central bank putting up interest rates, then you have a collapse in the value of consols, which causes a collapse in the value of bank equity. There's a rising equity value, then the rates get interest and equity plunges. And that's what we're going through right now. That's the basic dynamics that's occurring at the moment. So the actual position is less extreme than that. The inverse relationship between the price of bonds and the interest rate is weaker for the shorter the duration of bonds are. And banks also split their bonds into two categories, or at least two categories. One they call hold to maturity, and those are ones which they don't intend selling. So they're unaffected by the current value of the interest rate. The other is called available for sale, and they are affected. They have to revalue those. And individual banks can hedge their exposure to interest rates on fixed coupon bonds by swapping for variable rate bonds. But there's still a systemic risk. You can't get rid of the overall effect. The bond revaluation is reducing the equity of the banks. So rising interest rates could, as a result of that, eventually lead to negative credit. We haven't seen it happening quite yet, but it's certainly on the cards, and I think more so in Europe than in America. It will cause more bank failures. So here's this is just a matter of an hour or two ago. Another bank, PacWest Bancorp, its shares are plunging. So we had one bank fail yesterday. We could have another one join them. So bank failures are going to be a result of the actions of central banks, where they're trying to control the rate of interest, causing an economic crisis by bank failures, and also ultimately by suppressing credit when the interest rates pass through to private lenders' rates. Then we could have a collapse coming out of the collapsing credit-based demand. Now, when you look at the net effect, the overall effect of both credit and fiscal policy is still positive in many countries around here. But fundamentally, central banks are out of control because neoclassical economists are in control. So here's, pardon me, let's move this window out of the way. This is the level of credit in America, which has recovered substantially from the negative of the crisis and is running at about 10% of GDP. And government-created money is still positive at this stage. But if you take a look at the United Kingdom, pardon me, let's go back and do that again. The UK has almost zero credit-based demand, and fiat demand is running at negative 20% of GDP. So a strong effect of austerity is coming back again. And then you look at Italy, it's a similar story for Italy. Very weak credit-based demand and strongly negative demand coming from what should be government money creation. So I'm happy to, I'll just actually load that particular database here to have a conversation about it in the post talk. But we fundamentally have a financial crisis being caused by the people who are supposed to guard and protect the financial system. That's it. Let's have some conversation.
Jetzt
All right, sorry about the delay. There were some technical hitches here. Thank you very much, Steve. And it's incredible how slowly you can speak when you try. Well done. Let me go over to some of the questions. The first question is, when someone borrows from a bank, they are required to repay. Doesn't that mean that positive credit in one period automatically contributes to an equal negative effect on credit in future?
Again, I'm afraid to say, Matthew, my hearing is making it hard to understand that. Can you just try rolling it? Okay, sorry, try again. Yeah.
When someone borrows from a bank, they are required to repay. Doesn't this mean that positive credit in one period automatically contributes to an equal negative effect on credit in future?
No. This is one reason I invented my Minsky software, so we can actually clarify these things. What creates money is an operation that occurs on both the asset and the liability side of the banking sector. Now, that fundamentally boils down to four operations, pardon me. When a bank lends money, it increases its assets and it increases its liabilities. It adds to the loans that it has outstanding, which it's an asset, and it adds to the deposit accounts, which are a liability. And that creates money because fundamentally money is the liability of the banking sector towards the rest of the economy. So that's one operation. When the government runs a deficit, I now prefer to call a deficit a fiat, by the way, because I'm sick and tired of the stupid confusions I see amongst both politicians and journalists and, of course, mainstream economists. So when the government runs a deficit, via fiat, it increases the amount of money in your deposit accounts. It spends more on the public than it taxes back on the public, so that increases deposit accounts. And it also does this by increasing the reserves that banks have at the central bank. So the assets rise, which are the reserves, the liabilities rise, which are the deposits. That also creates money. Then when the Treasury pays interest on existing bonds, that increases the equity of the banking sector and it increases the reserves again. So that's an operation that occurs on both the asset and the liability stroke equity side of the banking sector. Finally, when the private banks sell bonds to the non-bank financial institutions, that effectively involves the non-bank financial institutions having deposit accounts at private banks. They reduce those by, let's say, $1 billion. And then as a result of that, the private banks transfer $1 billion worth of bonds from their books to the books of the non-bank financial institutions. That also has an operation that occurs on both the assets and the liabilities side of the banking sector. So those are the four types of operations that involve money creation or money destruction. Now, when you pay interest on an existing loan, money comes out of your deposit account and goes to the short-term equity of the bank. That is an operation that occurs on the liability equity side. It does not affect the asset side at all. So the credit creation is the taking out of a loan, paying interest on that redistributes the money, but it doesn't create or destroy any money.
All right. Second question. In how far has the Cantillon effect filtered into your thesis as a possible root cause of disequilibrium?
Again, I'm going to have to ask
All
you
right.
to repeat that. There's a lot of echo as well as my very bad hearing without my hearing aids right now, Matthew. So try
We'll get there.
again, please.
In how far has the Cantillon effect filtered into your thesis as a possible root cause of disequilibrium?
I might get you to type in future, just to type them in the chat so I see the questions in the chat. So if you can do that now, I'll get an idea. Yeah. Okay, so send them as email, I can submit it in that way as well. That's probably the best idea. So pop them all to me as email and I'll take a look at them that way. My apology, everybody else. I came over from Amsterdam a couple of weeks ago and forgot my hearing aids, and they haven't been sent to me, or they're lost in the mail between the Netherlands and Europe. So Netherlands and the UK. So I'm currently very deaf. which is not making it easy to be an academic here. Okay, how far is the Cantillon effect? Not a lot. I think disequilibrium is everywhere. So there are all effects that are going to give us disequilibrium. And that's what we have to get used to. And that's why I love Fisher's statement. He basically said you can assume that a variable tend towards equilibrium. But any equilibrium will be disturbed by some sort of random shock. So even if you believe things will head towards equilibrium, at almost every moment in time, they're going to be in disequilibrium. And the root causes of disequilibrium fundamentally come down to conflicts over the distribution of income. Workers demanding wage rises when they have the power to do so, firms putting up markups to try to reverse that, all these sorts of effects. So disequilibrium is the normal state of any healthy system. It isn't a negative to say that capitalism is in disequilibrium. We've made a fetish out of equilibrium when any living system is in a cycle state. So cycles are essential. This one, question 3, I'll read this out. Following a positive credit boom due to new technology, say canals, isn't negative credit fine as no more productive canals can be built, but the investment loan is paid off over many years, leaving everyone better off? Yes, this is a positive role for credit. I highly recommend, if anybody who hasn't yet read it, get a copy of Richard Vague's book, A Brief History of Derm. And Richard goes through in meticulous detail the major booms and slumps of the last 150 years in the major economies of the world, and makes the point that credit financed things like the railways boom. And even though many of the railway companies went bust, the positive impact of the physical resources created by the boom are still with us in railways that are still a productive element of modern society. So it's not a problem to have credit booms and busts. The problems come when there's too much private debt created. And I think we're probably carrying 2 or 3 times the level of private debt we should have in the economy. And when that private debt goes towards financing Ponzi schemes rather than financing productive investment. And of course, the global financial crisis with the bubble in house prices in America was a classic Ponzi scheme. So I'm not against credit, but I'm against it being leading to far too high level of private debt. And also when it's being used for financial speculation rather than actually producing genuine physical assets.
Yeah, we just had that. We haven't just kind of got. 1 moment, Steve.
Okay, Dan.
Okay.
We have a question from the audience. You just have to.
Is it in English or German?
It's in English.
Yeah, can I
Near
just...
the microphone.
I'll try to read it.
Just read the first one.
All right. Do we see cycles diminishing before the ongoing banking crisis? USA, EU financial instability hypothesis model. You can't hear this.
So people want me to explain the model.
No, I'm just wondering whether we are experiencing diminishing cycles as the model would predict in the ongoing banking crisis.
Okay. I don't think that's the factor right now. The diminishing cycles, when I first saw them, were a complete surprise to me. And they weren't part of Minsky's logic either. If you read Minsky, what he talked about was effectively one cycle, going from a boom, a recovery from a bust to a boom and then another crash on the other side. He didn't, he thought you'd ultimately get to the point where there was too much debt accumulated and you'd have a Great Depression. So he did see us reaching that point, but he had no idea about the size of cycles as you go forward. So if the effect that turns up in my model of diminishing cycles followed by rising cycles and then a crash, that is a classic case of a complex systems emergent property. And it took me a long time to get a logical explanation to myself as why that might happen. So this is where you have fundamentally a credit-based boom. But if you take a look at where we are right now, and I'll just check and see if the data sheet that I've loaded is sufficient to show that. No, it's not really. So I'll have to talk it through. that was what we've been through going from 1945 in America to 2008. So that was a level of private debt going from about 50% of GDP to 170%. And that then drove those distributional dynamics that turn up in my model. But since the crisis, we've had a fall in the level of private debt, nowhere near as much as it should have been. If you look at the Great Depression and the Second World War, we went from a level of private debt of 140% of GDP down to about 50%. So a substantial fall in the level of private debt. And that reset the potential for that long-term dynamic to come through. And that's what led to 2008, ultimately. This time around, we're in the aftermath there, but we still haven't escaped the aftermath. And the reason for that is we have neoclassical economists in charge again, and they don't understand the system itself. They don't even look at the level of private debt. The correlation that I show between credit and the unemployment rate between 1990 and 2014 is about minus 0.92. That is a ludicrously high level of correlation. And I'm happy to discuss the causal versus correlation issues there as well. Now, you'd think they'd want to look at it. I've been showing that at conferences, publishing it in papers, putting it in blogs. Not a single neoclassical economist has reacted. They continue ignoring it. But what they've done is by QE, which inflated asset prices, inflated the value of the financial sector as well, they've sustained sort of a sort of low-level pulse of capitalism in the what should have been a slump that came to an end, a continued level of slump until COVID struck. And then with COVID, what we had was enormous government spending, which is absolutely necessary to avoid a financial crisis during COVID. And what that meant was money was injected into the bank accounts of ordinary people, workers in particular. Some workers in America got more from the COVID rescue than they used to get in wages. Pardon me. That increased their capacity to spend. That's what's given us the shortest recession in the post period with COVID and a strong recovery of the economy afterwards. But there's no sustained momentum to the economy still, and we're still carrying too high a level of private debt. So I don't really expect credit-based demand to get up to the levels it got to in the 2007, 2008. I think we're still stumbling along. And what central banks are doing now is effectively kneecapping the recovery that was caused by the fiscal stimulus during COVID.
And remind him to speak slowly.
I'm supposed to tell you to speak slowly.
And there's also two questions.
Yeah, I'm doing it. I'm fine.
Yeah.
Did you get the email?
Looking at the question, let's see. Were there ever noteworthy cycles to speak of in Europe, USA, EU? Oh, yeah. And the cycles, are just riddled throughout the economic data. I'll go back and I'll show one of the slides that I know has got that long-term data there. So just give me a moment to find the relevant slide, just to illustrate the cyclical nature of the economy. Let's see. Okay, so let's take a look at this one. I'll share my screen in a moment once I've got the graph up. So there's the cycles and the unemployment rate, which are huge. They're happening all the time. So cycles are just a normal part of any functional system. I often tell my students that you believe you're in equilibrium. And if anybody answers yes, I'll say, well, what you're telling me is you're dead. And not only you're dead, you're frozen to absolute zero. Okay? There are cycles in us all the time. Circadian rhythms, heartbeat rhythms, all types of changes. And any living system will be cyclical. And in that sense, the economy is an extension of the living system of humans and human society. So cycles are there all the way through the data. It's only neoclassical economists who think the damn thing should be in equilibrium. So cycles are everywhere. And if you look at the European data, you'll find similar cyclical behavior all the time. So cycles are by definition the fundamental characteristic of a dynamic system.
Your emails is 5 further questions.
I'm seeing here. Do I see Bitcoin as a Ponzi scheme? Should I answer that one? Okay, I think I answered. The strange attractor. Can I? Okay. How is the disaggregation of inflation into its factors done? Okay, that's quite simple because it's a relationship which Koleski put together, not me, where he basically said you can define GDP in nominal terms as prices times real output. So you have Y, which can be your nominal GDP, is P times Q, where Q is real output. Then you can also define Q as being labor times labor productivity. And then you can define prices as being wages times a markup that capitalists put on prices. So you break it all down and you finally get an equation for the price level, which says it's 1 over 1 minus M, where M is the markup, multiplied by the money wage divided by labor productivity. So that's your basic equation for the level of prices. And then if you differentiate that with respect to time, you get the argument that change in prices is going to be change in the markup plus change in wages minus change in labor productivity. So that's the decomposition. Now, of course, when you go to the American data and data for any country in the world, you can find data on the nominal wage. You can find data on labor productivity. You can't find data, and part of me using the other finger, but you can guess why. You won't find data on the markup. They don't record the markup. Okay, but then I can use the growth rate and the inflation rate and the labor productivity rate and the wage rate to derive what the markup is as a residual. So that's why I put that data together. And this is similar to the work that Isabella Weber has done. And I recommend looking at her work as well from the Amherst, University of Amherst, Massachusetts Amherst. And they've gone through and said the fundamental cause of the inflation now has been the increase in the markup. Blair Fixstone finds the same sort of thing, but he disaggregates in much more detail than I do into the prices of numerous products, not just an overall aggregate price level. But the explanation I give for the increase in markup again comes back to Koleski. And Koleski said the markup was restrained by the degree, what he called the degree of competition. Now, I don't think in neoclassical terms about competition, obviously, but what I do think about is that when there's a high level of aggregate demand, then from the point of view of each individual producer, there's very little competition because any goods you put out on the shelves for sale are snatched up and out they go. Anything coming in the warehouse goes out the shop and gets sold very rapidly. So what you have when there's a high level of aggregate demand is a low perception of the level of competition and therefore an encouragement to manufacturers to put up their markups. Now that's, I think, what we've seen in this most recent period. So because of the enormous fiscal stimulus during COVID, plenty of demand existed for the goods and services that could be sold during COVID. So manufacturers put up their prices, put up their markups, and that's where the markup increase came from. Now, at the same time, we have a fall in productivity because of the impact of COVID on the extremely long supply chains we now have, and also the impact of energy, the impact of the Ukraine war, and so on. So your productivity will decline because of that. Output per worker will decline. So those where those factors come from. And I've done if anybody wants to find more information on that, if you go to my Substack website, which is profstevekeen.substack.com, or my Patreon, which is patreon.com/profstevekeen, look for the most recent post I've written on inflation. And I go through all those factors in those posts there in more detail than I can give an answer here. So is that a reasonable answer for the questioner there? Okay, so the next question there is, what role do the reserves play in the current banking crisis? Can you explain a bit more about reserves? Reserves are one of those elements of reality that have led to fantasy by mainstream economists. So reserves are, when they think reserves are created by a depositor walking into a bank and putting cash down on the table and say, put this in my bank account. So if you actually did that, if you walked into a bank with €1,000, gave it to the teller then puts that €1,000 in the safe and then gives you a receipt, which is what goes into your deposit account, increasing your deposit account by 1,000. So you've created reserves that way. Now, what the mainstream doesn't consider properly is that reserves actually created by the government. When the government runs a deficit and therefore creates fiat money, what it does is it transfers funds from its account at the central bank into the reserve accounts of the private banks at the central bank as well, where those funds are earmarked for particular individual recipients in the non-bank economy. So that then means the reserves rise when the deposits go up. So reserves are fundamentally created by government deficit. That's the main way that they're made. Now, if you then look at what neoclassicals think, and I'm using the word think very loosely here, they think that banks lend reserves. That's what they teach in their textbooks. And you'll also find it even in the minutes of the Federal Reserve, particularly if you read the minutes from 2007 to 2009, you'll find them all, the governors of the central banks in America, all the regional Federal Reserves, in particular the guy from Philadelphia, Charles Plosser, panicking about this increase in reserves being caused by quantitative easing and worrying that that increase in reserves would cause a runaway growth in loans. Now, if you take a look at the economics of it, the accounting of it, if you try to lend from reserves, that means you're getting a negative entry in reserves. So reserves are going to fall. If you try to then show a positive entry in deposits, you break the rules of accounting. The negative reserves must mean a negative, not a positive for the deposits. So reserves will fall when you take the money out of your bank and transfer it to another bank. But you cannot lend from reserves unless the loan is in cash. And then the reserves can fall, the loans will rise by as much. The depositor gets the borrower gets no money in the deposit account, but they get cash from the bank. So you can lend from reserves if and only if loans take the form of cash or other negotiable instruments. Now, when's the last time you got a loan from the bank that was in cash? Okay. It's a nonsense idea. So reserves play no role in lending. They play an essential role in the banking sector as a way of being able to transfer money from one bank to another. And they're also the conduit between the government and the non-banks and the non-bank private sector. So that's the fundamental role of reserves. The analogy I use for reserves versus money is that money is like the fuel in your car, talking in terms of an internal combustion engine car, of course, and reserves are like the oil. Now, what the mainstream economists think is you put oil into your engine block. And if you do that, your car is stuffed, okay? It's a bad analogy. So reserves are one circulation system between the banks and between the government and the banking sector. They're independent of the level of lending. Lending itself can generate a need for reserves in various ways, but the causation goes from loans to reserves, not vice versa. Okay, that's okay. And the strange attractory equilibrium. Yeah, this gets quite complicated. So pardon me if I get a bit hairy. And what I'll do, I'll bring up that slide and show it again so you can see the overall dynamics there as I talk it through. Let's see. Okay. So again, I'll just get this running and then share screen again. Okay. So there are the cycles. I'll wait till it starts to settle down before I talk it through. Pardon me, I shouldn't have pressed that button. I'll just, if I can drag it out to here. Let's see. Okay. So this involves a bit of technical speak around the mathematics of this particular model. When you solve for the equilibria of the system, you find there are three equilibria, two of which make sense. One of them involves negative employment, so you can rule that equilibrium out. So the two equilibrium, and my great friend Matteo Cristelli describes the one as the good equilibrium and the other as the bad equilibrium. Now, the good equilibrium has a finite employment rate, a finite wages share of GDP, and a finite debt level. So there's a positive employment, positive wages share of GDP, and positive private debt ratio. What he calls the bad equilibrium has a zero employment rate, a zero wages share of GDP, and infinite debt ratio. That's the bad equilibrium. Now, what you find is the more aggressive your capitalists are, in other words, the more they're willing to invest, which is what you would want capitalists to do, the more unstable the good equilibrium becomes. So as you push the rate of response of capitalists to the rate of profit, and that's what's going on here with this chart here, I've got the rate of profit determining investment as a percentage of GDP. The steeper that line is, the more likely firms are going to borrow more money during a boom than they can repay during a slump. So what that means is the level of debt will ratchet up over time. And the way the ratcheting up occurs is that initially the boom causes, the boom starts because the wages share has fallen and they're paying down debt as well. So you have output minus wages minus payment on debt is the rate of profit. As the wages share declines, the rate of profit increases. And as the level of private debt declines, the rate of profit increases. Now, at some point, you will reach the level in the investment function here, where the level of investment will be exactly equal to profits. And then at that point, as the rate of profit increases, firms will start wanting to borrow money once more. So they start driving the economy up. As they drive the economy up, wages start to rise and employment rises. And that is a non-linearity, because you have output minus wages multiplied by labor, where both wages and labor are variables in the system. So that rises non-linearly and cuts off the level of profit and causes another boom or a slump. So each time it happens, the level of private debt rises more during the boom than it falls during the slump. So you see these cyclical increases in the debt level. And what that means is there's a transfer of income from workers to bankers. So you notice here, as the cycles go on, the wages share of GDP falls as the rate of level of debt rises, whereas the profit rate is unaffected by the level of debt. It gets more unstable, but the equilibrium doesn't change. So that's the sort of cyclical dynamics going on there. Now, mathematically, as you increase the aggressiveness of the investment function, then you destabilize the good equilibrium and make stable the bad equilibrium. So initially the system gets attracted towards this good equilibrium, and that's a point where you have a stable employment rate, a stable wages share of GDP, and a stable debt ratio. So if I ran the model with those parameters, this would become a hill. Okay. But because you've destabilized it, you get attracted towards the good equilibrium for a while, but then as you get closer to it, in complex system terms, it's an unstable, strange attractor. It then pushes you away towards the bad equilibrium, and then you have the breakdown. And of course, unfortunately, that's what we've had in the 1920s, in the global financial crisis, and also back during the panic of 1837. And then finally, there's two more questions here. Do I see Bitcoin as a Ponzi scheme? Absolutely, I do, because the only value to Bitcoin is your capacity to sell it to somebody else. So fundamentally, it's not creating any value. I wish I could have a better conversation about it, but my hearing is so bad right now that I'd probably be forcing poor Mathew to repeat questions 5 times. Hang on, new message from Mathew here as well. Let's see, I'll take a look at that one. Kondraty of waves. I'm a bit of a skeptic. I'll just actually stop sharing my screen here. Okay. Kondraty was a good numerical analyst of cycles themselves, but he was trying to explain long waves and saying, well, there must be to get long cycles, you must have long waves. Now, in the model that I've shown you, my Minsky model, which is not the most complicated model I've built by any means, is actually the simplest model I've built. You'll see there's a long cycle as well as a short cycle. Now, there's absolutely no long-term dynamics in the model. The long-term cycles are the product of the short-term cycles. And this is something which we have come to understand in terms of complex systems now, that you don't need a long explanation for long cycles. So if I include the government sector in this model, I get quite even more dramatic amplification of waves heading towards it's an unstable but good equilibrium with the government sector included. So I continue getting increases and decreases in the level of economic activity coming out of that model. But again, there's absolutely no long-term dynamics in it. So I don't think Kondraty waves make sense. I think they're a pre-complex systems explanation for the behavior of complex systems. How should a European response to the Inflation Reduction Act look without creating a subsidy competition? I think you should create a subsidy competition. I'm a critic of comparative advantage and the whole idea of free trade. When you look at the empirical data, the countries which have succeeded did protect their economies for some substantial period, as well as putting their manufacturers under pressure to compete with imports. So I think it's nonsense to say that comparative advantage is good economic advice. So you would actually want, to some extent, competition on that front. And I think if you don't know my work on climate change, I think we're in for the enormous crisis, ecological crisis. If we're lucky, it might be 10, 15 years away. It's more likely sooner than that. The more money we spend building green infrastructure, nuclear power, whatever else can take us away from a dependence on carbon, the better. So I wish Europe would get in there and compete with America and do as much as they can in the so-called Inflation Reduction Act, but mainly using that to reduce our dependence upon fossil fuels. And let's see. So this one, from my understanding, in the popular media, the issue of interest maturity discrepancies was addressed, and this was reduced to SVB mismanagement. And also during the 2007 to 8 crisis, the issue of private debt in terms of mortgage over leveraging was addressed widely. I don't agree with that. Again, the idea that an individual bank can hedge its way out of exposure to interest rate volatility is true of an individual bank, but you can't hedge risk out of existence. You can't, if the overall value of bonds is going to fall, somebody has to wear it somewhere inside the system. So SVB was actually being a very conservative bank. It had far fewer loans than it had bonds in terms of long-term assets. It really was acting as a conduit for people to do transactions between deposit accounts. It was part of a payment system more than it was a lending or speculation system. There was obviously some mismanagement as well, but I think it just made them the canary in the coal mine. The coal mine was still having methane seeping into it. It was still dangerous, and the methane is being created by the central bankers, not by the financial system in this particular instance. Let's come back and check. Okay. So, any more questions? I hope my answers have been okay. Again, my hearing is bad, and I can't be sure how well I've actually said those things.
The interpreters are exhausted. Steve, thank you very, very much. I do want to say one thing for listeners is Steve does a regular series of podcasts with Phil Darby, which are on a more practical level about economics, most everything, but normally current events. So if you want to look at those, I don't have the email address, but it's very simple. Go to our website, look at the podcast, you'll find them immediately. There's a long series of them. Steve Keen, Phil Darby, go to one of those and then you'll be on the website where all these podcasts are being put up. How often do you do the podcast with Phil, Steve?
I do a podcast every week with Phil Darby. I also do a live discussion on Saturdays at, I think it's 6 o'clock European time, when it's been called Steve Keen and Friends. And you can find that on YouTube. I highly recommend it. It's a lot of fun for me. I thoroughly enjoy the discussions. We had a great one with Richard Murphy just recently. So if you look for Steve Keen and Friends on YouTube on a Saturday, and then Phil Darby will put out one of our podcasts pretty much every week. So those are the two probably best ways of getting free access to my ideas. And I'm going to suggest one that actually costs money in a moment. Just give me a moment to bring this up on screen, because I'm now giving a set of lectures, and the lectures were suggested to me by a marketing firm. And the marketing firm, I think, was a bit over the top in its initial advertisements. But I think, actually, I'll just bring it up on a notepad here and see if I can make it on the notepad. No, actually, I'll go back and share screen again. Pardon me, talking to myself here. So I'll share screen, and I don't know that you can actually, that's probably too small to see. So hang on a second, I'll take a copy of it and paste it in PowerPoint here. So if you'd like to sign up for my lectures, instead of 16 lectures now, let's just hang on. That's the way to get a absolutely full coverage of my approach to economics. And I was initially skeptical about the courses themselves as when it was suggested to me by the marketing firm, but I have to say the caliber of the people who've turned up in the group so far, and the caliber of the lectures as well, which I'm being pushed into by just how good my audience is, I think it's extremely worthwhile, and I'd recommend anybody who wants to get used to my non-orthodox approach to economics to sign up to those lectures. And that's it from me.
Thank you, Oscar and Florian, and of course, Frank and Sven. And we'll see each other, I hope, in September. So take care and enjoy your summer. Steve, we have your hearing aid.
Thank you.
Let us Skype.
Okay. I'll hopefully next time with my hearing aids. Okay, bye everybody.
Bye-bye.